You're at the dealership, eyes on that shiny new car. The salesperson smiles. Just $399 a month. Stretch it to 84 months, keep your payments low, and drive home today. You think $399? I can swing that. No big deal, I deserve this upgrade. You sign the papers, drive off feeling like a boss. Low monthly payment, no stress. But 2 to 3 years later, the nightmare starts. Your car's worth $15,000 less than you owe. You're upside down. Rates tick up, payments jump $50 to $100 per month. Repairs hit and you're still locked in for years. Suddenly that easy loan is a financial prison. This isn't hype, it's happening to millions. In 2026, the average auto loan term is 72 to 84 months, Experian data, with rates at 7 to 10% bank rate. On a $40,000 car, that means $10,000 to $20,000 plus an interest alone over the life of the loan. And 40 to 50% of long-term borrowers end up upside down in the first 3 years, Edmunds owing more than the car is worth as depreciation kicks in hard. You think long loans make cars affordable? Wrong, they're a disaster, turning a depreciating asset into a debt anchor that drags your wealth down for years. Continuing our series on hidden cost cars insurance luxury traps, today we expose car loan danger. Why 72 to 84-month loans in 2026 are a total financial disaster, the 8 biggest risks. The brutal math over 5 to 10 years, and how to escape the trap without losing thousands. If you're in a long car loan right now, or thinking about one for your next vehicle, watch this entire video. It could save you $10,000 to $30,000 in wasted interest and regret before it's too late. Let's break it down. Why are 72 to 84-month car loans more dangerous in 2026 than ever before? Because the combination of high prices, high rates, and fast depreciation creates a perfect storm for financial disaster. New car prices average $48,000 to $50,000. Kelley Blue Book 2026, with most loans falling in the $35,000 to $45,000 range, Edmunds data. Interest rates hover at 7 to 10% bank rate, and dealers push long terms to keep monthly payments affordable. $400 to $600 per month sounds reasonable, so buyers sign up. The psychology is powerful. People want nicer cars, better features, or SUVs for family, but incomes haven't kept pace with rising costs. Long loans make it feel possible. I can handle $450 per month. What they don't see is the trap: the car depreciates fast, while the loan balance shrinks slowly. Depreciation hits hardest in the early years, 20 to 30% in year one. So with a long loan, you pay interest on a high balance while the car's value drops below what you owe. Upside down loans are now extremely common. Example, you finance $40,000 at 8% over 84 months. Monthly payment $550, but total interest paid over the life $15,000 plus. After 5 years, the car might be worth only $20,000, 50% loss, but you still owe $20,000 to $25,000. You're upside down or barely breaking even with years of payments left. This isn't rare. It's the new normal for long-term loans. The longer the term, the deeper the hole. When things go wrong, job loss, repair bill, market dip, dealers love it. They get the sale. You get the debt. This sets up the first major danger: upside down loans. Let's break it down. Danger number 1, and the most common reason long car loans become disasters, is the upside down loan, owing more on the car than it's worth. New cars lose value fast, 20 to 30% in the first year alone. Edmunds and Kelley Blue Book 2026. With a 72 to 84-month loan, your balance decreases slowly. Mostly interest early on while the car's market value drops quickly. By year 2 to 3, most long-term borrowers are upside down. Data shows 40 to 50% of people with 72 to 84-month loans end up upside down within the first 3 years, Edmunds and Experian. That means if you need to sell trade-in or total the car in an accident, you owe thousands more than insurance or trade-in value covers. Real example, you finance $40,000 at 8% over 84 months. Monthly payment $550. Year 1 car depreciates to $28,000 to $32,000, 20 to 30% loss. But you've only paid down $3,000 to $4,000. Principal still owe $36,000 to $37,000. Year 3, car worth $18,000 to $22,000, but you owe $25,000 to $28,000, upside down by $5,000 to $10,000. If you get in an accident and total it, insurance pays the current value $18,000, but you still owe $25,000. You're on the hook for the gap unless you have gap insurance, which costs extra. The brutal math. Every month you're upside down, you're paying interest on money you effectively lost to depreciation. Over 5 years, that gap can cost $5,000 to $15,000 in extra interest and stress. Sell early to escape, you lose even more on trade-in or private sale. Dealers push long loans because they close the deal, not because they're good for you. Upside down status locks you in, making it hard to sell or trade without bringing cash to closing. This is the foundation of the disaster. Next, the massive interest snowball that makes long loans even more expensive. Danger number 2 is the interest snowball. The massive amount of extra money you pay just for stretching the loan over 72 to 84 months. In 2026, with auto loan rates at 7 to 10%, bank rate average long terms turns small monthly payments into huge lifetime costs. Example, you finance $40,000 at 8% over 84 months. Monthly payment $550, but total interest paid over the full term $15,000 to $20,000. That's $15,000 to $20,000 wasted on interest alone, not principal. Compare same $40,000 loan at 8% over 60 months, 5 years. Monthly payment jumps to $810, but total interest drops to $8,500 to $10,000. You save $5,000 to $10,000 in interest just by shortening the term. The brutal math, every extra month you stretch the loan, you pay more interest on a balance that's barely decreasing. Early on, most payments go to interest in the first 2 to 3 years. If you keep the loan full 84 months, you're paying nearly 50% of the original loan amount in interest, turning a $40,000 car into a $55,000 to $60,000 purchase. Real example, a driver takes a $40,000 loan at 8% over 84 months. They pay $550 per month for 7 years to total paid $55,000 to $58,000 principal, plus $15,000 to $18,000 interest. If they paid extra to finish in 60 months, total paid $48,000 to $50,000, saving $5,000 to $8,000 in interest. Plus, they own the car free and clear 2 years sooner. Long loans feel affordable monthly, but they snowball interest into a wealth killer. Dealers love them, they get the sale. You pay the price for years. This interest burden compounds the upside-down problem. Next, the even bigger danger opportunity cost, and how long loans slow your path to real wealth. Danger number 3 is the silent killer most people never see coming. Opportunity cost, the massive wealth you lose by tying up money in long car loans instead of investing it. When you commit to $500 to $700 per month on a long loan, that cash flow is locked. You can't redirect it to retirement debt, payoff, or investments. Over 5 to 10 years, the difference is staggering. Example, you finance a $40,000 car over 84 months at 8% monthly payment, $550. If instead you bought a cheaper car or paid more upfront and invested the $500 per month difference at a conservative 7 to 9% return, S&P 500 historical average after inflation, That money grows to $50,000 to $80,000 in 10 years through compounding. But with the long loan, you're paying interest, not building assets while missing those investment gains. Add in depreciation and the total opportunity loss is even bigger. Real example. A middle-class family earning $100,000 takes a $40,000 loan over 84 months. Monthly $550 eats into their budget. They skip maxing 401k contributions or cut back on Roth IRA. Over 10 years, interest paid $15,000 to $20,000. Missed investments redirecting $200 to $300 per month to 401k. At 8%, $50,000 to $100,000 plus in lost growth. Total wealth destruction, $65,000 to $120,000, enough to change retirement security or fund a home down payment. The brutal math. Every dollar spent on long car loans is a dollar that stops working for you. The car depreciates, interest drains, and you miss compounding growth, turning a reward purchase into a long-term wealth killer. This isn't abstract, it's why many middle-class families feel stuck despite decent incomes. Long loans don't make cars affordable. They make financial freedom unaffordable. Next, how this pushes people into house poor on wheels, stretched thin across all budgets. Danger number 4 is where long car loans start feeling like house poor, but on wheels. You're not just stretched on housing. Now your car payment is eating your budget too. When you commit to a 72 to 84 month loan on a $40,000 to $50,000 car, the monthly payment $500 to $700 is only the beginning. Add insurance $150 to $300 per month. Gas/charging $150 to $300 maintenance. $100 to $200 registration/fees, $20 to $50. Suddenly, your total car costs hit $900 to $1,500 per month. For a middle-class household earning $100,000 to $150,000 after taxes, $6,000 to $9,000 per month take-home. That's 15 to 25% of your income locked into the car. The trade-offs are real and painful. You cut back on maxing your 401k or Roth IRA, missing employer matches or compound growth. Vacations get shorter or canceled. Kids' activities lessens or college savings get reduced. Emergency fund stays small. One big repair pushes you to credit cards. Example, a family earning $100,000 takes a $40,000 loan over 84 months. Monthly car costs total $1,000 payment plus insurance plus fuel plus upkeep. That's 12% of take-home pay, equivalent to a second mortgage. They skip contributing $300 per month to retirement arrow over 10 years. At 8% return, that's $50,000 to $60,000 lost in growth. They feel successful with the nice car, but their net worth is flat or declining. This isn't abstract, it's the same trap as upgrading houses too soon. Long car loans create car poor living, stretched thin, stressed about every bill and unable to build real wealth. You're not driving to freedom, you're driving into a deeper financial hole. This squeeze leads to even more dangers. Next, the resale trap, emotional stress, and the long-term debt cycle that keeps people trapped. Danger number 5, the resale trap. Long loans plus fast depreciation equals you're upside down for years. When you try to sell or trade early common at 3 to 5 years, you lose big. Example, you owe $25,000, but the car is worth $18,000. You need to bring $7,000 cash to closing just to walk away. Dealers roll it into a new loan, restarting the cycle with even higher debt. Danger number 6, emotional and mental stress. Every month you see the payment, worry about repairs, or dread the next insurance hike. You feel trapped, can't sell without losing money, can't afford upgrades, and regret the decision. The joy of the new car fades fast, replaced by anxiety. Did I make a mistake? How do I get out? This constant stress erodes happiness and financial confidence. Danger number 7, the long-term debt cycle. Long loans make it easy to roll negative equity into the next car. You trade in upside down, add the gap to the new loan, and repeat longer terms, higher interest, bigger payments. Many end up in a perpetual car payment loop, never owning free and clear. Combined example. A driver takes a $40,000 loan over 84 months at 8%. Interest paid $15,000 to $20,000. Upside down loss on early trade $5,000 to $10,000. Missed investments redirecting payments $50,000 to $80,000. Lost growth over 10 years. Emotional toll plus cycle repeat adds more debt and stress. Total damage $30,000 to $80,000 plus indirect losses, enough to delay retirement, reduce savings, or force lifestyle cuts. The brutal math: long car loans don't make cars affordable, they make financial freedom unaffordable. They compound every other danger: upside down status, interest, snowball, missed opportunities, and emotional weight. This isn't sustainable. Next, when long loans might still make sense, rarely, and practical ways to escape the disaster before it buries you. So how do you escape the car loan danger in 2026 and avoid turning your next vehicle into a financial disaster? Here are the proven actionable strategies that protect your wealth. 1. Limit your loan term to 36 to 60 months, never go beyond 60. Shorter terms mean less interest paid overall. Example: $30,000 loan at 8%. Over 84 months, total interest $15,000. Over 60 months, $6,000, you save $9,000 in interest. Own the car free and clear 2 years sooner and reduce upside down risk dramatically. 2. Put down a high down payment, 20 to 30% or more. The more you pay up front, the less you borrow and the less interest accrues. A 30% down payment on a $40,000 car drops the loan to $28,000. Interest falls by $4,000 to $6,000 over the term. It also keeps you from being upside down from day one. 3. Buy used or pay cash if possible. Target reliable 2 to 4-year-old cars. CPO if you want warranty. Avoid new car depreciation hit. Cash eliminates interest entirely. If you can't pay cash, save aggressively first. Example: save $30,000 cash for a used car, arrow 0 interest. Total cost $30,000 versus $45,000 plus financed over 84 months. 4. Pay extra principal every month. Even $50 to $100 extra goes straight to principal, shortening the loan and slashing interest. Example: $40,000 loan at 8% over 84 months. Add $100 per month, arrow finish in 60 months, save $5,000 to $7,000 in interest. 5. Calculate full cost before signing. Use tools like Bankrate or Edmunds loan calculator. Include interest, depreciation, insurance, fuel, maintenance over 5 years. If total ownership costs greater than 10 to 15% of income, walk away. Real example: a buyer wants a $40,000 car. Instead of 84 months, $550 per month, they put 30% down. $12,000 finance, $28,000. Over 60 months, $500 per month, add $100 extra per month. Arrow finish in 48 months, save $6,000 interest and avoid upside down risk. They drive free and clear sooner with more money to invest. These aren't sacrifices, they're smart moves that protect your wealth. Dealers push long loans for sales volume, you don't have to fall for it. Now, let's wrap this up with the key takeaways and what you should do right now. To sum it up, 72 to 84 month car loans in 2026 are a financial disaster for most people. They create upside down loans owing more than the car's worth, snowball massive interest, $10,000 to $20,000, plus wasted destroy opportunity cost, tens to hundreds of thousands in lost investments. Push you into house poor on wheels, 15 to 25% income locked in car costs, trap you in resale pain, add emotional stress, and feed a long-term debt cycle that's hard to escape. The brutal math doesn't lie. Long loans don't make cars affordable, they make financial freedom unaffordable. A $40,000 car over 84 months costs you $55,000 to $60,000 total principal plus interest, while a shorter loan or cash buy saves $5,000 to $15,000 and lets you own free sooner. That difference compounds into real wealth over time or drains it if you stretch. This ties directly to our series, Just Like Houses Have Hidden Costs That Trap You Long. Car loans are a hidden debt trap that compounds every other expense, depreciation, insurance, repairs, and leaves middle-class families stretched thin, stressed, and building less wealth. Final advice: cap loan terms at 36 to 60 months, never 72 plus. Put down 20 to 30% plus to reduce borrowing. Buy used or pay cash when possible. Pay extra principal monthly to shorten the loan. Calculate full 5 to 10 year costs before signing. If it feels too good, it probably is. Don't let a car loan steal your future. Cars are tools, treat them like one, not like a status symbol or emotional reward. Now I want to hear from you. Are you currently in a 72 to 84 month car loan? What's the loan amount, interest rate, monthly payment, and your household income range? Drop it in the comments. I'll reply with a quick personalized analysis. How much interest you're losing, upside down, risk opportunity cost, and specific steps to escape faster. If this video opened your eyes or helped you rethink your next car loan, smash that like button, subscribe, and turn on notifications for more 2026 financial truths. No hype, just the hard math. Thanks for watching. Drive smart, borrow short, and keep your money growing. See you in the next one.